Hello, everyone. It's Bill and Jonathan with Carolina Capital Management. Welcome to our show. So, have you ever wondered about the risk of the different loan to values on your collateralization? So, in other words, if you have a loan or if you're borrowing money and the LTV is a certain amount,
There can't be
and
risk,
that's
right?
that's loan to value.
Yeah.
You're assuming if you're at say 70% of that value, there's not really much risk, right?
Let's find out.
We'll find out right after this. Wow, I love that intro. So, welcome to the show. This is the what is it called? The passive income active wealth show.
Active income, passive wealth.
It shows up right on the screen every time, and I still get it wrong.
I love it.
It's just old age. All right. So we are Carolina Capital Management. We do make loans throughout the Southeast. So if you are a borrower in the Southeast looking for investment loan, CarolinaHardMoney.com. Just click on the Apply Now tab. If you're an investor looking for passive returns, click on the Investor tab.
And even if you're looking for some active returns,
yeah,
we'll help you out.
Yeah, we'll put you to work.
Yeah.
Don't forget to share, like, subscribe, hit the bell, all that good stuff. And we have a chat either on the side or underneath the screen, depending on the platform that you are. So you can always ask a question. We always like comments that are good. If they're a bad comment, then keep it to yourself. So let's listen. It's a lot of breaking news.
There is some news.
Needless to say. So wow, that's awesome. That's a new one.
That's new. That's nice.
They're always keeping us on our toes.
That's right.
Okay, so Joe Biden was certified through Congress late last night. Well,
Ratified,
actually, early this morning, they ratified the election. At the same time, we had those 2 Senate seats in Georgia go to the Democrat side of the aisle. What does that mean for real estate investors? Well, for one thing, for the next 2 years, I think it's going to be awesome.
I agree. Yeah. I mean, and depending on what you are in, yeah, I think there's definitely, we talk about this all the time. There's a housing need that hasn't stopped, and that's not going to stop just because a new president is in the office.
Well,
or I guess, what is it? The executive branch now has the power to block all Republican all Republican I guess bills through the Senate, and they have the power to pass.
Well, not the executive.
Well, that's true. Kamala Harris is.
Well, she breaks the tie.
Exactly. She's the 51st.
But when she's breaking the tie, she's part of the Senate.
Technically, but
But anyway, he's right. The only agendas that will get through are going to be the Democratic agendas. Now, if you're worried all hell is breaking loose, well, that may happen, but probably not for the first couple of years.
Yeah, probably not.
Here's in a nutshell what's going to happen. At least that's my crystal ball. So Democrats are famous for spending, throwing money at problems, a lot more money than conservatives typically want to do.
Mm-hmm.
But they're going to do a lot on infrastructure spending. They're going to throw a lot of money at this economy. The Fed is going to continue to print money. The upside to that is there's going to be plenty of capital out there. There's going to be plenty of construction projects going on. How is that going to help you as a real estate investor? Well, it's going to hurt you in one way is you're not going to have as many trades available because they're going to need them. One of the problems that we've had in this country is that students have been discouraged to do anything outside of a 4-year college degree and not getting your fingers dirty.
Yeah.
And we have a shortage of trades. So there's going to be a lot of need for trades people with all this infrastructure construction going on.
Yeah, electricians, plumbers, framers, carpenters,
Yeah.
you name. I mean,
Well, what's going to end up happening is there's going to be a lot of money thrown at the economy, which means money is going to be cheap and easy because the Fed's going to continue to print money. What's the downside to that is that the dollars are worth less.
Inflation rises, dollars worth less.
Yeah. So your hedge against inflation is going to be real estate.
Correct.
People still always are going to need a place to live. So their rental properties are going to be a good bet. Single family is always a good bet because it can be a income producing property. It can be a fix and flip type of a sale.
Mm-hmm.
That said, people are going to have plenty of jobs available to them with all this construction going on if they get trained right, and you'll still have plenty of demand for housing.
Yeah. Okay? I see people, they're talking about, precious metals and stuff like that. I guess that's fine. If it were me and I was doing something outside of real estate, I would do natural resources, water, gas, solar power, or some kind of power. I would do that. Gold, I don't know. And this is just my personal opinion. As we get more to a digitized economy where all the money is digitized, how valuable is gold?
Well, look at Bitcoin. It actually reached $38,000.
Yeah, exactly.
And I don't know if it's as much for the coin itself, but the blockchain technology is going to be here with us, especially now that everything we do is remote anymore.
Yeah,
it's really difficult to have to do, personal signatures in some place with several parties that are there. So the blockchain is really going to help with that.
Yeah, you're right.
I think. The job numbers, they were a little slightly better than expected, but I mean, it's still awful.
Yeah.
The continuing claims were slightly up, and they're going to continue to go up as COVID kind of stays with us until they get these vaccines rolled out. You're going to have places that are locking down, and people are just going to be out of work. So in the short term, the job numbers, you're probably going to see higher unemployment numbers coming up.
Well, yeah,
for at least a short term until they get this vaccine rolling out, and everybody gets the, what do you call it, the herd immunity thing going on. But again, what's going to end up happening with all this spending, because we don't have the money, it's all going to be borrowed. Eventually, they're going to have to start doing the taxing, and that's, for me, that's the harm in doing all this spending. It's got to come from somewhere. Taxes are going to go up, fees are going to go up, regulations are going to become more active. One of the things that the Trump administration did was they really took a lot of layers of regulation off of business. Who does that help the most?
Small business.
Right.
Yeah.
So big business loves regulation because it quells their competition, because they have the money to overcome all these different layers of regulation. There were times where it would take so long to build a road. The original construction companies that won the bid were out of business by the time it was approved, because it took them so long they couldn't wait. But the bigger global companies love regulation because it squashes their competition.
Yep.
And the other thing that it does, which is not good for the economy in general, is that it also squashes innovation, because it's the small businesses, the people that find the niches that add innovation to the economy. And that's all going to get squashed because, well, a lot of it is going to get squashed because people just don't have the capital to compete long enough through the layers upon layers of regulations that a lot of different businesses have to overcome.
Yep.
And listen, don't get me wrong. There's nothing wrong with regulations. You have to have regulations. You have to be regulated for safety reasons, as well as not impinging on the rights of others.
Mhm.
The problem is when you have too much of a bureaucracy. It's like 14 different agencies that have regulations on the same thing.
Yep.
And every one of them have to sign off before you can get anything done. And that ends up becoming a problem. So short term, we're going to see a lot of money going into the economy. So
Mhm.
I'm for at least the next couple of years. Uh, I think it's going to be full bore. I mean, the stock market is going through the roof, but again, it's kind of to me, it's kind of a house of cards. Um, it's based on all this, extra money that's being injected into the
Extra
system.
money and
But
a lot of speculation.
but the price of the dollar is going to now it is up the last few days, but it's going to your money's going to be worth less and less. So inflation is going to end up rearing its head. Um, the the 10-year bond actually was up over 1%. It was 1.02 or somewhere in that range. So you're probably going to see fairly soon the end of the sub 3% 30-year fixed rate mortgage.
Mhm.
But you know what? It's all relative. I
Yeah,
mean, anything south of 6% is is still a good rate. Don't you agree?
I agree.
And what's going to happen when rates go up?
Well, we're going to see more, or I guess less people purchasing, less
Right?
people refinancing.
And what happens after that?
Well, then you have the trickle down, and then
Well, it's market forces. And this is what I'm trying to get to.
yeah,
Um, Prices of homes have continued to go up and up and up. And it's a
yeah,
seller's market right
yeah,
now. So um, eventually it's going to be a buyer's market
hmm
because, the fewer people can afford homes, the longer they stay on the market, which means people will have to come down on their prices
hmm
to sell those homes so they can afford them. And so that's the market forces that are going to start to bring the pricing pressure down a little bit
yep,
in the single family markets.
yep.
Now, again, it's all real estate is local, so it's going to be different in every market. But for the most part, uh,
I don't
the
know
higher
any.
the higher the rates, generally the prices come down. The lower the rates, the prices go up.
Yeah,
But it's also a supply and demand thing. So there are several things that are
and
involved.
there's like multiple facets in there, like the price of the cost of the goods. Lumber right now. I mean,
Yeah,
it's
lumber is
insane.
through the roof.
Yeah.
I think it doubled this year, didn't it? They're pretty close to it.
I don't know. Yeah, my rehabs definitely my one I'm finishing up right now. It's way over budget, and it's mostly because of increased price of
Yeah,
lumber
materials.
and materials. Yeah.
And then think about it. You're going to have as these, and again, it's going to take a little while to move it through Congress and the Senate, but infrastructure spending goes up, then you're going to also have to compete for subs and trades and
Yeah.
whatnot. So the
And
cost
if
of
there's
labor is going to go up.
and if there's not that many of them because people have been discouraged to do that trade.
Well, but besides the discouragement to get into the trades in particular,
hmm
you also had people that were in the trades that got out during the crash of
Yeah.
'08 because the housing market took a big tumble and they were getting into another line of work because there wasn't a
hmm
lot of building going on.
Yeah. hmm
So they went into other lines of work. So maybe they'll come out of retirement or
So
we'll see. Listen, there's always opportunity where uh, things look rough. You always have to look at the opportunity side of it. So
mhm.
let's get to our question. If a loan is collateralized, oh, I'm sorry, the ugly question.
Dun, dun, dun.
Sorry, I didn't give you enough time to react. So, if a loan is collateralized by a house and you're at 70% of the value, how can there be any risk? You would think at 70% there wouldn't be much risk at all, right?
So the what I would go to is the 2007, 8, 9. Did any markets? compressed by more than 30%?
Some,
But not
not
all.
many.
But some did.
Yeah.
Okay. So that tells me there's risk.
Yeah. Well, you saying we call them the sand states. So
Well, yeah, you're talking about Florida.
parts of Florida, the Nevada. So you're talking about Las Vegas, Phoenix, LA. A lot of those markets dropped quite a bit during the crash.
Mm-hmm. Yeah.
And I mean quite a bit. Some of them lost 50% of their value.
Yeah, exactly.
And then it was, I don't know that it was super widespread across all the price ranges, but on average, I mean, there were some homes that lost 50% of their value.
Well, I mean, in the more high price the home, the more percentage of value that it lost. I mean, would you agree with that?
Yeah.
Did a $4 million house lose more percentage of value than a $200,000 house?
Yeah.
Yeah.
So that tells you that, and this is going to happen everywhere through all cycles.
Mm.
That the more affordable housing is going to lose less of a percentage than the upper middle class type and luxury homes.
Yeah.
And then homes again that are really in second home locations,
Mm-hmm.
they're going to lose a lot of value because you can't afford that second home.
Yeah.
You either walk away from it or you try and sell it, and then when everybody's trying to sell it,
Yeah.
then obviously the values go down.
Yeah.
Right?
Yeah. And but aside from just complete market collapse, if you're at 70% LTV on a property, I mean, it's how did you structure the loan? I mean, did you give the borrower 100% of the purchase and all the rehab, and you were at 70% of the ARV?
Yeah.
And you go out there and your borrower's gone, they're not making payments, and there's been nothing done to the house. Well, now, yeah, you have a big problem.
Yeah, listen, there's the risk changes based on current value versus subject to completion value.
Mm-hmm.
So if you're at 70% of the as is,
mm-hmm.
then you're a much lower risk than you would be at 70% of the completed value.
Mm-hmm.
How do you mitigate that risk? Well, part of that is holding on to the rehab money.
Correct. Correct.
So there's nothing you can do about market forces.
Yep.
Those things are out of your control.
Mm-hmm.
I was at the gym last night, and one of the young ladies there said, "I don't even look at the news anymore. I'm afraid to even go and see what's happening today, because it just worries me to death." And I said to her, "You have to, first of all, stop watching the news. you have to be informed, but you don't watch it every day.
Mm-hmm.
Control the things that you control, and don't worry about all the other stuff that's out of your control, because there's nothing you can do about it. So worrying about it, it's a waste of your focus. Focus on what you can do and not worry about that."
Mm-hmm.
And that's what we do in real estate. We focus on what is in our control and using the best data at the time.
Yep.
And to mitigate your risk is to hold on to those funds and make sure that you have them in case you do have to take a property back.
Mm-hmm.
Now, that said, if you're doing your job properly as a lender and the inspections are proper and the construction is up to par,
Mm-hmm.
before you continue through these things, the only thing that's going to hurt you is something that's out of your control, like a market downturn.
Yeah.
Before it gets sold.
Yeah. Well, I mean, a foreclosure, let's just say you're at 70% of the as-is value, it's completed, and you have to foreclose. That value that you have on that property that you're 70% of is probably going to diminish, because now it's not, right. It's not an arm's length sale, it's an REO, and that diminishes the value. I've sold a lot of foreclosure REO homes. I'm not sure that there might be one that we got the full appraised value on.
Right.
And it's very rare. It's very rare.
Well, it's a different property now.
Yeah. No, exactly. Yeah.
Anything that's in mid construction, is
even completed.
Yeah, well,
it's distressed.
And yeah, I was going to get to that.
Yeah.
If it's in mid construction and you're selling it at a discount because there's only so many people that are going to want to buy a house that's not been completed yet.
Yep.
At the same time, even when it's finished, it's a house that you had to take back in foreclosure, and now it's compared to other foreclosures when the appraisals come in.
Yep.
Now, I want to be very clear. When you're at 70%, 65%, your goal as a lender or a banker is to come in, grab that property back because they didn't pay, and try and make money on it. Because you're typically not going to make money on it because they haven't paid you in a while, and you have accumulated interest that should be collected. You have late fees that need to be collected. You have expenses that are coming out of your pocket for upkeep of the yard, the taxes, all kinds of stuff, insurance, all that stuff still has to be maintained. And if you're in the foreclosure process, it takes 2, 3, 4 months, and it depends on what state you're in. Sometimes it takes a year to 2 years
or 4. Yeah.
I know Jonathan was talking about one that he had with a previous company that when he started that company, it was in foreclosure, and
when I left 4 years later, it was
still in foreclosure.
Yeah.
That's why you want to make sure you make deals in less regulated states, let's say, right? That said, that 30% or 35% or 40% of a cushion that you have is so you won't lose principal.
Yep.
That's what it's about. It's not losing principal. Are you losing money if you've lost principal? Well, it depends on when you had to start the foreclosure. If you did it after the first payment, you only got one payment on it. But if you've had the thing for 5, 6 months and it's not selling or what, for whatever reason, you've got 5 or 6 payments that you made, and you're getting your principal back. So you made money, you just didn't make as much as you thought.
Yeah.
But the goal in these things, again, the 30%, 35% is to not lose any of your principal.
Yep.
I wanted to make sure that you guys saw over here in the chat. Those are the links to our next show coming up. We have a great guest. It is Nick Allerud, and he is a real estate investor. He owns a real estate company. He does property management, fix and flips, wholesale, new construction, short sale.
He does it all.
All kinds of stuff. Yeah. He's going to be a great guest to have on, and that starts at 12:30. So thank you, guys. I hope you enjoyed our bloviating for the first half hour.
Yeah. And just remember, there's always risk in real estate.
Yeah.
Anyone who tells you otherwise, run from them.
Listen, there's risk in any investment. The reason we like real estate is because you have a tangible asset and you're less likely to lose any principal when you're investing in real estate if you do it properly.
Yep.
The big run up that we had prior to 2008 were people that were speculating, not investing. They just assumed prices. And we're getting into that point now where people are buying homes just thinking that, hey, I hold this for a year and I can sell it for a lot more. And I see a lot of that going on, right?
Yeah.
But remember, that stuff stops eventually.
Yeah. Also, if someone tells you a deal is a no-brainer, run.
Don't forget to like, share, and subscribe. Hit the bell. We are Carolina Capital Management. We do make loans. Go to carolinahardmoney.com if you're a borrower and click on the Apply Now tab. If you're an investor looking for passive returns, click on the Investor tab. Thank you so much for joining us, and click on one of the links to get over to the other side, and we'll see you here at 12:30. See you later.